When most people want to buy a stock, they look at the current price, place an order, and hope it goes up. But there is an alternative approach, where you can set a lower, discounted target price for the stock you want, and actually get paid cash to wait for it to drop. This is the options wheel strategy. It is a continuous two-phase system that relies on selling option contracts to generate income from stocks you already want to own. Phase 1 begins with cash. Let's say stock XYZ is currently trading at $30 per share. You have cash in your account, and you wouldn't mind owning the stock at $28. Instead of placing a traditional limit order, you sell a cash-secured put option at a $28 strike price. By taking on the obligation to buy the stock at $28 if it drops, you instantly collect $100 in premium. If 30 days pass and stock XYZ stays above $28, the option expires worthless. You don't buy the stock, but you do keep the premium. You bank that profit, reset the wheel, and sell another put to collect more income. You are taking cash sitting idle in your brokerage account and converting it into an active income stream. And because you set the strike price below the current market value, you collect that income even if the stock goes completely sideways or slightly down. Eventually, the stock will drop. If XYZ plummets to $26 by expiration, you are assigned. You are now forced to buy 100 shares at your agreed-upon $28 strike price, paying more than the current market value. For an unprepared trader, this causes panic. But in this system, assignment is not a failure. It is the necessary, calculated trigger that moves the strategy into its second phase. You now own the shares. Before making the next move, we evaluate the real math. You bought the stock at $28, but you were paid $1 per share in premium up front. That means your true break-even cost basis is exactly $27 per share. Now we use those newly acquired shares to generate more income. You sell a covered call option, agreeing to sell your shares if the stock recovers to $29. For taking on this obligation, you immediately collect a second $100 premium. Traditional investors buy a stock and need it to climb to see a return. By utilizing option premiums to lower the cost basis at every step, you engineer a mathematically lower entry point than the rest of the market. To understand why buyers continuously pay these premiums, we have to look at the Greeks, specifically theta. Theta measures time decay. Every single day an option gets closer to its expiration date, its extrinsic value steadily melts away. This graph shows the rate of an option's time decay. The decline is gradual at first, but notice the drop-off right here. The curve steepens dramatically as it crosses the 45-day threshold. Option sellers target this exact 30 to 45-day window to capture the fastest, most profitable rate of decay. The other variable is implied volatility. If the market expects massive price swings, premiums inflate. You can collect huge payments by selling option A right at the current stock price, but your risk of assignment is exceptionally high. Option B sits further away, paying out less premium, but offering a high probability of expiring worthless. To find the optimal balance between worthwhile premium and acceptable risk, sellers look for the 30 delta mark. In simple terms, a 30 delta contract has roughly a 30% mathematical probability of finishing in the money. Mastering the wheel means stepping away from guessing stock direction. You operate like an insurance company, pricing your risks strictly using probabilities, volatility, and the unavoidable decay of time. This chart shows how the wheel performs in different environments. Because of the consistent premium collection, it handily outperforms traditional buy-and-hold strategies in sideways or slightly bearish markets. But because your upside is capped by your covered call strikes, it will underperform during massive vertical spikes. Let's test this logic. Stock ZYX is trading at $50. You sell a $48 put and collect $2 in premium. At expiration, the stock drops to $45 and you are assigned the shares. Pause the video right here. Calculate your exact cost basis per share and then determine the absolute lowest strike price you can safely choose for your Phase 2 covered call. Let's check the math. You are forced to buy at $48, minus the $2 in premium you already collected. Your cost basis is $46. To protect your capital, you must draw a strict covered call safety line at exactly $46. If you panic during a drop and sell a call option below your true cost basis, you guarantee a net loss if the shares are called away. Calculating this baseline correctly is your strict defense against compounding losses. Returning to our original XYZ trade, where our cost basis was $27 and we sold a $29 call. Let's say positive earnings hit and the stock rockets back to $30. Because the price crossed your strike, your shares are automatically called away from you at $29. You collected $100 from the put, you collected $100 from the call, and you made $200 on the stock itself, buying at $27 and selling at $29. The single rotation yielded $400 in total profit. The shares are gone. Your initial capital, plus the new profit, is deposited right back into your cash balance. You are now perfectly positioned to restart the strategy from phase 1. A durable system requires strict rules. Rule 1, only run this on quality stocks you actually want to hold. Rule 2, target expiration dates 30 to 45 days out to maximize time decay. And Rule 3, look for implied volatility between 30 and 60%, selling at roughly a 30 delta. The options wheel extracts reliable income from the simple mechanics of time decay and volatility. By relying on probabilities rather than predictions, you create a methodical engine where consistency ultimately outperforms speculation.